All right, so we moved down 2% today on the S&P 500. Pretty significant gaps to the downside on the Qs, potential for runaway gaps. I mean, it was like signals firing all across the board that pullback has started. Now the question is, was the selling in the last 3 days, what's driven that selling? So I'm going to talk about that just in this past 3 days. What does that mean in terms of how this intermediate decline is going to look like, whether that changes our expectations or not, and what will the intermediate decline look like? And I'm also going to talk about, was the selling too extreme in the last 3 days? So what do we expect going into the weekend? I'm going to talk about that as well. And of course, obviously anything can happen in a day or two, but doesn't mean that I won't kind of give you an idea of what I think could happen in the short term, and then what I think about what's going to happen next week. And then, like I said, how the intermediate decline will get going, and then what it will look like, what will drive it to the downside. With our trade idea being a stock that would most likely participate in that environment, how we can trade it, keep our risk low. So let's go ahead and get started. Today is Wednesday, May the 12th, 2021. This is the Market Outlook from MarketScholars.com. My name is David Settle. All right, well, let's start off taking a look at the S&P 500 with the market forecast indicator. So you can see, obviously, the breakdown that occurred here. You have a light pink shading in the yellow line signal. We are almost 2% below the moving average. Earlier today, I tweeted this out. Where was that? I tweeted this out. That we had a pretty bullish signal here on the market forecast. At the time, the near-term line was just a smidgen below 20. It was like a 19.14. We were only a 1.33% below the moving average. Obviously, since then, that's a good bullish pattern. Again, very short term, as we'll talk about here in just a minute. But since then, we finished even more down below, and we finished down more than 2%, which is a significant number on the S&P. Still the near-term line stayed just a smidgen, but the 17.75. I still think there's a pretty decent chance that we bounce. And you notice we still haven't broken the 23% retracement. So we technically still haven't started a pullback yet. This is just noise. The problem is when you're so bullish, it takes a bigger move. Like we've been so bullish for 6 months. We haven't had a pullback. It takes a pretty significant move to be more than just noise. When you've been on an intermediate run, as we have been for the S&P for 6 months. We did get another extremely oversold momentum line. So I still, and last time we kind of did that too, where we had an oversold near-term line and kind of back-to-back extreme lows that ended up being a little bit of a... Now, I do not expect this kind of move to coming out of here. But I do expect a little bit of a near-term pop to come out. And I doubt it will get up to higher highs. It might not even get back above the moving average. It might not even get above 80. But I do expect the near-term line to bounce out of this, which would coincide with a little bit of a selling. And as I mentioned again in my tweet, if that happens, do not, and the market will talk about is the correction over with. Do not, I tweeted this out too, do not get caught up in this idea that the correction is over because of this chart. When we've had an 89% rally without a 10% correction, and we've only been down almost 4% now, because we came down a little bit lower after I sent this out. That is not a correction, right? That is a correction. This is a correction, right? This is a correction. That's a pretty decent correction of that big long move, right? That's obviously a correction. This, not a correction. So if and when if we do bounce off of this, and the market does, we get a little bit of a pop here. Right over here. If we get a little bit of a pop here, the correction will not be over. This is not the correction. We haven't started the correction yet. We won't start the correction until we break 4,000 on the S&P 500. I know that's going to be painful for people, but that's the reality when you're up 89%. And when you're up, I believe, what was it, off of this level? Off of this low point up to that high point, that's a rally of 31% almost, an annualized return of 60%. So when you're up 30% in 6 months plus a few days, a 3% drop is not a pullback, right? That's less. That's about a 10% drop. A 38% drop is a pullback. So obviously 38% of 31% is going to be, 30% is going to be like 10. So 33 is going to be 10. So that's the kind of drop, again, just to get us down to there. And I think actually we'll end up coming down here at least to this 23% retracement level of the long-term move, right, of this big long-term move off the COVID low. That's what these lines are drawn on. So at least coming down to there, and there's a 50% Fibonacci retracement level sitting on top of it, or we're going to come down on a bigger decline down to here. And this is actually what I'm expecting because we've been so bullish for so long. I expect we'll hit the 38% retracement of this market sentiment rally and the 78% retracement of this long-term run that we've been in. The NASDAQ obviously looks a lot worse for wear. Remember, it did have an intermediate pullback. It has started to pull back. And in fact, if you were to draw this on the same lines, same move that the S&P is drawn on, you notice we have now broken the 23% retracement. So the NASDAQ has broken below that level, whereas the S&P is getting close. The NASDAQ is there. We have dark pink shading. We don't have a yellow line or a red line yet because it hasn't rolled over, but we are significantly below the moving average there. When you look at how far, whether we're 1.5%, which is kind of the mark I look for, we are well beyond. We were flirting with 2 on the S&P. We're 5% below the moving average. So this is a pullback signal on the Russell 2000, and you can see, the NASDAQ. You can see the Russell 2000 now it has touched. It's done this before, and we rallied off of this. But that's also a breach. Now you notice the near-term line did not finish in oversold territory, even like it did over here, where it went to an extreme low. So again, I still think that there's an opportunity. But if we break this 2130 level, then there's nothing down there. I've been showing this chart to my class, which is why we're hedged against the Russell 2000. Once we break this level of volume, because it's been so top heavy, you go back all the way to January 25th. If I were to do the volume profile to January the 25th here, just to see where the volume has occurred on this particular move. Actually, I'm going to go back to, let's just do it for now. No, I'm going to do it this way. I'm going to go back to the volume profile off of this move, off of the March 19th low point. March 19th low point. So I'm going to time frame this March 19th of 2020 up until now. And let's take that probability of expiring cone because it smushes the chart together. So there is the rally. So we had a lot of volume early coming off of that low point in COVID. And then we went sideways, right? Here in September, we had the intermediate pullback on everything in September and October. So we produced a lot of volume right there. And you remember the Russell took off. The Russell went parabolic right here. In this kind of first few months, if you look at the directional movement index, let me bring up a separate chart for that. We'll look at here. When you look at the directional movement in the indicator for IWM, we went parabolic right there, right initially, right off of that November. Boom, the ADX got all the way up. We hit that level, and we started to slow down on the ADX, but with this higher highs, we were gradually getting lower highs in the ADX with higher highs here, lower highs on the positive indicator, really lower highs, and much higher low when we got to that peak, that we just went sideways. So because we went so parabolic so fast, up to this point, there's no volume there. And then initially, too, no volume. But we have had a lot of volume since, so we're very top heavy. There's a lot of volume down here. So this is telling us that the Russell 2000 has a good chance of dropping all the way down to 160 because there just isn't very much volume. There's a little bit at the 200 mark, and there's a big round number there. But there's a good chance that that's how far back we can go. That's the 50% retracement of the COVID move. That's a mark that we've been kind of watching for a long time of when this decline will end. And that's kind of what I'm watching there on the Russell. So it's got a lot worse margin of safety than like the NASDAQ composite does. So you can see. But again, I believe we could still get probably into the weekend, maybe a little bit of a short-term bounce. And that would be it. Like, I'm not looking for another near-term rally. I'm not looking for new near-term highs. I'm looking for maybe one or two. I'm looking for you can see the near-term line here. This peak didn't last very long. That's the type of near-term rally I'm expecting before things finally really hits the fan, so to speak, and this decline starts. All right, before we look at some other charts, I invite you to subscribe to our YouTube channel. Mouse over this icon here in the bottom right corner of your screen. Hit the red subscribe button that pops out. There's also one down below the video if you're watching us on YouTube with a little bell next to it. Click that bell as well. That notifies you when our videos are posted. Also, while you're down there, hit that thumbs up icon. That lets us know two things. Number one, you liked our video today. And number two, that you want us to do another one tomorrow. A quick way to give us feedback if you like our videos. Of course, if you don't like our videos, you don't even have to watch. You don't have to click on anything. You don't have to watch. But if you do like our videos and want to let us know, you can do it right now with one click while you're watching. That goes a long way for us. It helps get our video out to a bigger audience. Just that small of a deal. So we really appreciate those who do like our videos. Also, while you're down there, comment. What stood out to you? What questions or comments do you have? Why should other people watch it as they're coming for the first time? Post those in the comment section. Join our website at marketscholars.com. There's a link popping out right up there in the top right corner of your screen. Click on that link to subscribe to our site for free. Follow me on Twitter for more content in between the videos from day to day. There's my handle right there at DavidSettle42. And join our Market Outlook Facebook group that we've created. All right, if you're watching us on our blog here, scroll down to this page and click on any of these things on the right, including our Market Outlook live video. Again, every day I do the Market Outlook. I also do another video, a live video on YouTube those days. This is where you can get to it. Click on this link. It's for our paid subscribers. Any of our paid subscribers get access to that. We review all the trades that we've done in Market Outlook to see how they're doing, whether we should close them or not, or whether we should stay into them. Also, our trading rooms, you can see over here on the right as well. Again, all of our paid subscribers get access to all of our trading rooms and that Market Outlook Live. Of course, our premium subscribers get access to those things for less money per month than our month-to-month contracts do. Plus, in addition to the premium, you get premium tools as well as premium access to our community. Come down here, click on this heart. It opens up a new tab. Hit that like button right there. Also click on this thumbs up icon, opens up another new tab. Click that like button as well. Again, the more you do that, the more our content gets out to the people who follow us. We got over 100. It's been a while since I've been over 100. So I appreciate those who are liking our content. Again, it helps us because all of our followers will see our content that have engagements. That's why we ask for it. It helps you because Twitter and Facebook will promote content in your timelines from the accounts that you engage with the most. So, for example, I've been tweeting out quite a few things today. If you want to make sure you're seeing all the stuff I'm tweeting out, engage with it, click it, like it, and then Twitter will say, okay, well, we're going to keep showing that person all of David's content because they always engage with it. All right, now let's take a look at the weekly chart here, and you can see the bearish candle we're getting, but we haven't had that big of a wide spread in quite a while. Our Hakinyashi differential now is turned negative here. Now, granted, the week's not over with, but more than likely we're going to turn negative. The purple line hasn't gone negative yet, but you can kind of get an idea that it actually has for, no, it has for the NASDAQ. If we look at the Hakinyashi differential here, I believe it's this one. Yeah, it actually has gone negative. So that's a pretty bearish candle there. And then, of course, the Russell 2000, you can also see the same thing. Again, this is measuring how big the bodies are on this. Because remember, the body is not the open and the close. The open is the midpoint of the prior candle's body. And the close is the average of the high, open, high, low, and close of the actual candle. So that's why it's a little different. The body might not be the same size. In fact, you notice the Hakinyashi body is a lot smaller than the regular Hakinyashi body, or the regular candle's body is, because that's how it's not the same level. So that for it to be negative, again, is pretty significant. It shows just how bearish that we're starting to be. Right, even if, again, maybe a short term. And the other thing to keep in mind too, and I've told you this before, that the biggest up moves that we get on the upside occur when we're having the big moves to the downside. So not that I'm expecting a big up move, but I wouldn't be surprised to get a green candle or two here. We got a pretty decent. I mean, it's the first time we've been below 2% in a while since we had the pullback on the Qs. Pretty decent sized gaps too. The IWM actually closed below 3%, signaling again that's pullback mode. And then QQQ is 2 days down. 2 out of the last 3 have been below 2%, with some pretty significant gaps here. And if you look at the gap on QQQ. You notice, so that one hasn't filled in, but that wasn't very significant. Then we had a pretty decent sized gap yesterday, but it filled in. And then today's gap, we started to run right from the open. So if there's a gap for QQQ that could be signaling that we are now in pullback mode on this particular chart, it was that gap. It's a more than one standard deviation gap to the downside, and we finished down 2%, and we ran from the beginning. So it has a very good chance of being a runaway gap that doesn't get filled in for a while. So we're definitely leaning in the direction. If you notice, well below 200 on the CCI, which again can signal a short-term pop. When you get these really, really low CCIs, that can set some short-term low points. So that's why, again, I kind of expect that will bounce up in the very, very short term. You can see the divergence on the NASDAQ, which would suggest if we did bounce up, we'll probably bounce up to right there, 13,725 on the NASDAQ 100. You can see the RSI getting below 200 on there. Again, you can see when we get that, it tends to be just short-term bounces. And again, at least a short-term bounce. And that's kind of what we are dropping below 40 on the Russell, which has been a while. So we are definitely, and I told you this one on Wednesday, that we had gotten the signal here. Well, we're definitely, and we're above 30 and below 20 at the same time. That's a bearish pattern. You see it on SPY, you see it on QQQ, and you see it on item. In fact, look at the ADX on QQQ has actually run up above 20 now. It's so wide, and Russell 2000 starting there. So we are in the beginnings. Even if we kind of, there's an opportunity that we could just start to kind of fall out of bed tomorrow. More than likely, that's not going to happen. More than likely, we'll get a short-term bounce, get people thinking the correction is over, and then we'll fall out of the bed to the levels that we talked about before. If you take a look at the intraday chart today for the S&P, so it'd be this one here. There's your, we didn't look at let's look at the 3 green arrow chart really quick. We didn't look at that one for SPY. Again, you see how we are breaking down below 30-day moving average, but the moving average for the stochastics is still above 60. The moving average for the MACD is well above 0. So again, has an opportunity for a kind of a really big move, short-term bounce, because we're so oversold in the short term. But don't last long, because IWM, the MACD the moving average is below 0. It has dropped below 50 here. And you look at QQQ, and it's dropped, the MACD's dropped below 0. The moving average for the stochastic is well below 40. So it is in bearish territory. So you would expect that the SPY will eventually move in that direction too. One thing that's been interesting about the QQQ is this level here. We've been looking at this chart quite a bit, this ratio chart. I was laughing at CNBC when they were talking about, well, gold didn't go up today. Gold went up a lot today. Now, in dollar terms, no, it didn't go up, but in stock terms, it went up a lot. And so it's like, you've got to compare. You're always comparing one currency to something, one asset price to something else. So you're not just looking at, when you're talking about gold in absolute terms, you're not talking about gold by itself. You're talking about gold compared to the dollar, because that's what gold is priced in US dollars. So if you're going to compare gold to the stock market, which is what she was doing, she didn't price gold in stocks. Gold price in stocks has been taking off like a rocket ship. That's kind of what prompted my tweet there. Is like, come on. The CNBC person who was asking the question, her background in reporting has been in the currency market. She should know more than anybody that you never look at anything on an absolute basis. You look at it on a relative basis. And gold in dollar terms might not be up, but gold in stock terms is spiking, which is a reflection of this inflationary scare that we're getting right now. But of course, if you look at QQQ relative to IWM, has not been going up. We've been kind of stalling. It actually went up a little bit today there. You can see just a smidgen. Remember, as this goes up, see the MACD is rolling back up. The PPO is already rising. The CCI has gone back up above 0. The RSI. As this rises, I believe it's going to rise with a pullback, right? Where IWM will fall more than QQQ will, and that will push this up. And then eventually, when we do bottom out, then I expect QQQ will go back up more than IWM will, at least initially. And we'll make this ratio continue to go up. So as it goes back up to start, it should go back up to start during a risk-off type move, and I believe we're going to start seeing that more and more here after maybe, like I said, $1 a day or two of a difference there. If you look at, now let's go to the intraday range, and I showed you again a new low point, another new low point. It's very, very rare to get a new low just a day or two, like we got one yesterday, to get a new low just a day or two after getting a new high on the 4-week basis. It shows how sideways we've been, and that's why, I mean, we are breaking down out of this sideways action. A new low again today. If you look at the volume and trading range today, so the trading range ended up being 8.5 points. The high 412.59, the close there so about a 1.5 of gap that we didn't fill in. So that is, you end up about 10 points of range. And look at the volume, 134 million shares trading hands. So let's put that in context. 134 million shares is way out of the chart for the last year. So again, pretty extreme. 10 points, also way off the chart. Again, granted, it's going to move these lines up, and that's bearish when they go up. But it's also really extreme. Like, had it been only like a 6 or 7 point range day today, then you could say, okay, we're going to keep following that through. But to have a 10-point range with the gap and to have 134 million shares, that's pretty extreme, and more than likely signals just, again, a short-term bounce before more of a concerted drop to the downside. You can also see the VIX made a run up to 28. It got up above 95%, did not get above 100 yet. 105 is when an official intermediate pullback has begun. So we're not quite, or 115 is when the market sentiment pullback has begun. We're not quite there yet either. So I expect it will drop back down into this neutral range first in the next day or two, and then make a run from 90+% somewhere in this area back all the way up to the intermediate decline. So that's my expectations. We'll see how that plays out. Again, in a day or two, anything can possibly happen, and we can fall out of bed tomorrow. But I think we'll have a little bit of a respite first that will get people thinking it's over, that this was it, which is laughable. But the reality is that there's, again, if this is, and I'll bring this up, if this is, and again, let me get rid of the, see, we had a 9.6% drop during that last intermediate pullback, the only one we've had since the COVID low point. But if I were to take that out and just go to 10% declines from close to close, right? 10% declines from close to close. If you are struggling with a 4% pullback after an 89% rally, then and you're not prepared for, this kind, if you're not prepared for these kind of drops after those kind of rallies, with the expectations that you get these kind of rallies after those kind of drops, then you're going to have a hard time in the next couple of months. You're going to have a really hard time because we've had a really good year. We're going to get some of it back because that's how markets work. And then we're going to really take off again from there when it's all said and done. So if you're dying right now with 4%, you are way too much risk on the table. And get ready, because it's going to be, by the time we're all said and done, it's going to be more than, we're going to get a number like one of these, right? Whatever it ends up being, at least 10%. If not, I believe closer to 15 or 20, right? Because I believe we're coming down into this area, right, kind of down in here. So I believe we'll be in the 15 to 20% area by the time it's all said and done. And then we'll get another rally right after it. However, 57, 44, whatever ends up being, that's what will come out of it. So like I said, 4% is what we're at now. This should pretty give, again, it's a pretty good kind of like, you should look at yourself and say, am I going crazy in the last 3 days? If you are, because of that, then boy, you need to take a look at what you're doing. If you're not, like our market scholars have been just fine, because we've been talking about this forever, right? And we've been prepared, and the types of bullish trades we're making we're not loading up, and we're hedged. We got really good hedge, so we're just fine. And so that's the reason why we do what we do here at Market Scholars, so that more and more of you who watch these videos don't get so worked up about what still is pretty much a noisy move, a very noisy move, but still a pretty noisy move that has, likelihood of turning into a pullback, and we might be a day or two away, but I think we are still a day or two away. we're a little bit of a rally first, and the next week I think is going to be the week that is not going to be so good for people. So what do you think? Do you agree with that assessment? Do you disagree? Let me know in the comment section below, especially if you disagree. What are you seeing, or what charts or indicators are you seeing that suggest why you're a lot more bullish than I am, that maybe this is correction and we're really going to take off from here, or that you're a lot more bearish than I am, that we're not only going to fall off the bed maybe a little earlier, but it's going to be more than just a pullback. So let me know in the comment section if you're seeing things that would suggest, like I said, that stronger posture on either direction than what we've shown here, and share that with our community below. All right, now let's take a look at how the different asset classes are performing here. And interestingly enough, commodities didn't start going down today. They're still actually holding up pretty well. And there's obviously the pipeline issue that will have an issue with crude oil prices, at least from a headline perspective, if not necessarily from it's more of a gasoline issue than a crude oil issue. But you can see the equities down here at the bottom, emerging markets, QQQ. This is only over the last 3 months. Of course, if you go all the way back out to when this whole intermediate rally started for the S&P 500 on the Halloween low point last year, then this is how things have been performing. And so you can see, okay, we've had a good run and we're giving some of it back. It's not surprising in the least bit. What's interesting over the last 3 days is... over the last 3 days here, so let's go to May 10th, and we'll go to a 10-minute chart, is bonds are not rallying. I mean, they're outperforming stocks, but they're not rallying. And gold is not up, as Sarah Eisen would say, but, I mean, come on, Sarah, like, gold is killing every other asset class out there except for the dollar. So, like, yes, gold is up. It's just not up in dollar terms, because the dollar is rising right now. But it is up in every other term, like whether you're comparing it to the Qs, whether you're comparing it to small cap stocks, whether you're comparing it to real estate, whether you're comparing it to long-term bonds, gold is outperforming everything. So gold is up. That's really stupid and it kind of shows how amateur she is, and she knows better when she's only quoting gold in the one asset class that actually was up today, and that was the US dollar. Let's take a look at the and sorry, it's a soapboxing for me, that's why I'm so harping on her so much. But the other thing too that stands out to me here is the VIX is really high right now. It's extreme. When you make extreme moves like this, I expect a little bit of a drop first before we really take off. So that's kind of an issue for volatility. But if you take a look at the Euro US dollar and the move it's doing, it's been on a little bit of a bullish run, right? The ADX is above 30, or the positive is above 30. The negative indicator hasn't jumped up yet above 20. This is how it ended. So there's actually today. There's today's move. So the dollar did hit this resistance level. Here, let's do it this way. It's just a little easier to see. And you see that we haven't quite ended the bullish run yet on the euro dollar, but you see how we got up to that 23% retracement, and last time that sparked a really significant drop all the way down to the 38% line of the bigger longer term move that we see here, all the way down to that level after we failed at that 23% retracement level. I believe that we're failing there again, and we're going to start working our way back down into the retracement zone and potentially back down into that area one more time during the next during the actual risk off move. And that will put pressure on gold in dollar terms, but I believe that gold will still be bullish in overall, especially compared to stocks. Well, I still believe that we'll still rally here. And yeah, gold, when the dollar goes up like it did during this period, gold went down, but gold went down with bonds, right, during that same period. If bonds go up, and bonds are, a very extreme short-term sentiment here, there's going to come a time where bonds bounce back up off this short-term extreme low point. Gold goes up with it, and the dollar goes up, and that's your risk-off move, right? That's when equities will be more on. So give it another day or two of a little bit of a bounce back, but then the safety trade is definitely showing itself, and it will also show itself here, and it hasn't quite yet. But this extreme move we've had on commodities, when you look at this parabolic move we've been on in commodities, that will be ending too. And that will be another sign of the broader risk off. We had the extreme there, the parabolic move. We've been on a pretty strong move since. We're already back down below 10 on the positive or negative indicator. I believe we're kind of oversold there, and we're going to now start really working our way back down. And gold will stay up, but commodities will come back down. And again, like I said, risk off. That's what risk off will look like. All right, when you look at this is the run that sectors have been on since that September 24th low when the Russell started its run. You can see the strong performances in materials and industrials and financials and energy. They're starting to roll over, right? Not surprisingly. But just this week alone, when you look at just the last 3 days that we've been so bearish here, it's been XLK, XLY, and XLC. In fact, you can see the staples trades, the energy and financials are actually outperforming utilities and real estate. So, our safety trade is kind of mixed in with these smaller weighted sectors. So we really, when we are in risk off mode, it's not going to be the QQQs that lead us down, as we talked about already with this chart. When this is going to go up when we're in risk off mode, it's not. These don't have the bigger losses to experience these areas. Where did it go? Sorry. Here. These don't have the bigger, whoops, not that one. This one. These don't have the biggest gains to lose. It's these areas that have such a big gains to lose, which means that they'll be the ones on this side. XLK, XLY, and XLC will be up here, and then your safety sectors will be, if not above zero, closer to zero. That will be your true risk-off pattern. And so today, this 3 days has not been it. So this, it's been risk off, but it's been into this tech area. I believe that these, we'll see a little bit of a bounce first. And then these are the areas that are going to lead us to the downside. And when they lead us to the downside, like I show you here, that's the long-term pattern here. Energy is moving down to the left. Financials moving down to the left. Materials and energy are starting to move down to the left. Staples, utilities, healthcare, real estate, all starting to move up to the right on the long-term chart, but not on the short-term chart. You still have energy, financials, materials, and industrials moving up to the right. Once they roll over to the downside, then and line back up with the longer term pattern, then that's it. That will be the peak. Then we're rolling over, and like I said, that will occur maybe in the next couple of days. Right, one last little hurrah, one last near-term rally before it's all said and done, and we follow this pattern, which again, what it looks like on this chart is, not that chart. This chart is XLK, XLY, XLC will be above the black line, or at least around it. All of these areas, these smaller weighted sectors, will all be down here at the bottom, and then your safe haven areas will be at the top. You can see on this chart the real significant decline in XLK and XLY. We are in pullback mode, but you notice it hasn't shown up yet in financials, industrials, materials, energy. Right? They're still really strongly bullish, and barely light pink shading in the industrials, and the yellow lines a bullish pattern. So I think we'll get, these areas will lead a last little 1 or 2 day little near-term bounce, and then we'll see the sell-off where they will join what we're seeing in all of these others, right? And your safe haven areas will drop. They just won't drop nearly as much, not to the same extent, especially as the ones here in the middle. So for our trade idea of the day, I wanted to take a look at one stock that's been really bullish, that has gone parabolic, that has since been settling down, and that's Home Depot. A little bit of a divergence there. In fact, you can see that divergence after hitting that parabolic peak. You can see the divergence here on the RSI, real significant divergence, breaking below 50, breaking below 0 on the CCI, breaking below the lows of the divergence. You can also see the divergence here on the MACD and stochastics, lower highs, again breaking below the lows of that divergence. And if you look at the Bollinger Bands for Home Depot, you can see this little rally, how far we moved up above the 1 year value area. I believe that we've got to move back down to the value area because there's no volume down below where you're at. And if you look at this, like say, this, a lot of that volume that we see is over the last 6 months or so. If I look just at a 6 month chart, you can see how significant that gap in volume is. We can really move down here, like I said, towards 280 because there's just no volume. We moved up so far, so fast, and very little volume that, as I've told you before, as fast as you can go up on little volume, if it's on little volume, you can go down on, just as fast. And that's what's going on right now with Home Depot. You can see some other extremes in the indicator and the stock. The transition candle you're seeing there, which is bearish on the regular candle. That's a bearish transition candle, which suggests bearish candles going forward from here. The PPO is really high on a relative basis, so there's opportunity to get down not only to the 50-day, but into that gap to the 200-day, which is usually what happens when you have a gap between the two and you break the one. So that sets us up for a bearish trade. And so what I did is I sold a put vertical spread. I bought the put 295 put in the June expiration, sold the 290 put. And so what ends up happening is it gives me this bearish trade. I've got a little room to work with. If we do bounce up in a day or two, I've got that much room all the way up to probably about another $10 or so. As long as the max gain stays inside of 1 standard deviation. More than likely, remember, if the stock drops, it's going to drop more than 1 standard deviation, but because that's how stocks, fear is a much powerful motivator than greed is. But for 500, for a half a normal position size, I can get a 4-to-1 reward to risk ratio, and very easy to get out. I mean, if we get to 330, if we get all the way back up above that volume node, then that's breaking above 330. Then I can get out with half of my risk. So I end up with about an 8-to-1 reward to risk ratio for $250. Trying to make $2,000 is a really good setup, and I like that. So I like if it bounces up, it gives me some room to work with. It doesn't have to go down tomorrow. It'd be nice if it did, but it doesn't have to. And even if it comes down to 280 and bounces, I can bounce all the way back up to 290, and I'd be fine. We've got that. That's where our short strike price is. So that's our trade idea for today. All right, you've heard from me. Now I want to hear from you. Use that link popping out in the top right corner of your screen. That takes you to our Market Outlook forums. You get access, all of our subscribers, even our free subscribers, get access to the Market Outlook forum. So open up a new thread there, reply to other people's threads about what questions or comments you have about the video, about what's going on in the markets. And let's keep this conversation going in between videos. As always, thank you very much for watching. Remember to subscribe to our YouTube channel, hit that thumbs up icon, comment on our video. Remember to also like us on Twitter and Facebook too. Have a great rest of your Wednesday night, everybody, and we'll see you all next time.